A magic money tree? Not so fast. The idea sounds enchanting, but let's dig a little deeper. Ever wonder why governments don't just print more money to pay off their debts? It seems like a straightforward solution, right? Seems like an easy solution, right? Just fire up the printing presses and wipe the slate clean. But hold on a minute. If it were that simple, wouldn't everyone be doing it? The reality is far more complex. Printing excessive amounts of money to erase debt is a recipe for economic disaster. But why is that? If printing money could solve all our problems, every country would be rich beyond measure. But the truth is, it leads to inflation. The truth is, printing excessive amounts of money to erase debt is a recipe for economic disaster. Inflation can spiral out of control, devaluing the currency. Think of it like this. Imagine you have a delicious cake. Printing more money is like adding more and more air to the cake. It might look bigger at first, but you're not actually getting more cake. The substance remains the same, but the value diminishes. It might look bigger at first, but you're not actually getting more cake. The substance remains the same, but the value diminishes. This is what happens with money when too much is printed. In this essay, we'll explore why printing money to pay off debt is a bad idea. We'll look at historical examples and the consequences faced by those who tried. We'll delve into the world of money, inflation, and the delicate balance that keeps economies stable. Understanding these concepts is crucial for grasping why simply printing more money isn't the answer. Get ready for a wild ride through the world of economics. We'll uncover the hidden mechanisms that keep our financial systems in check and why the magic money tree is just a myth. From shiny rocks to ones and zeros, money has evolved in fascinating ways. Before we dive into the nitty-gritty, let's define what we mean by money. It's more than just coins and bills. In the simplest terms, money is anything that people widely accept as payment for goods and services. This can include physical items like coins and bills, as well as digital forms like cryptocurrencies. It has three main functions: a medium of exchange, a unit of account, and a store of value. These functions make it easier for us to trade, measure, and save. Throughout history, money has taken many forms. From the barter system to the complex financial instruments we use today, the concept of money has continually adapted to meet the needs of society. We've used everything from shiny rocks and shells to gold coins and paper bills. Each form of money had its own unique characteristics and value. Today, we primarily use fiat money, which is not backed by a physical commodity like gold, but by the government that issued it. This type of money relies on trust in the issuing authority. Think of the dollars in your wallet. These pieces of paper are valuable because we all agree they are. Or the pounds in your pocket. They serve the same purpose, facilitating trade and commerce in our daily lives. And let's not forget digital money. With the rise of technology, digital currencies like Bitcoin and other cryptocurrencies are becoming more prevalent, adding a new dimension to what we consider money. Whether it's through credit cards, mobile payment apps, or digital wallets, the way we use money continues to evolve, reflecting the changing landscape of our economy. The money printing machine, governments, treasuries, and central banks. These entities play a crucial role in the financial system, ensuring the stability and flow of money within an economy. Contrary to popular belief, money isn't just printed willy-nilly. There's a meticulous and regulated process behind it. There's a whole process involving governments, treasuries, and central banks. Each of these institutions has a specific role to play in the creation and distribution of money. When a government needs more money, it issues bonds, which are essentially IOUs. These bonds are promises to pay back the borrowed amount with interest at a later date. These bonds are bought by individuals, businesses, and even other countries. Investors see them as a safe place to park their money, expecting a return over time. The central bank, like the Federal Reserve in the United States, then steps in. It plays a pivotal role in managing the country's monetary policy. They buy these bonds from the government using newly created money. This process is known as open market operations. This new money is then injected into the economy. It helps to stimulate economic activity by increasing the money supply. But the key takeaway is that printing money isn't as simple as turning on a printing press. It's a complex interplay of various financial mechanisms designed to maintain economic stability. Inflating the balloon. More money, higher prices. Now let's get to the heart of the matter. Why is printing too much money a problem? The answer, my friends, is inflation. Inflation is a general increase in the prices of goods and services. When more money is in circulation, each unit of currency buys less. Imagine you have a balloon. The air inside represents the money supply, and the balloon itself represents the economy. When you blow more air into the balloon, print more money, it expands, prices rise. Too much air and the balloon pops, hyperinflation. Section 5. Hyperinflation. When money goes haywire. Hyperinflation is a rapid and excessive form of inflation. It's like regular inflation on steroids. Prices skyrocket, and the value of money plummets. People lose confidence in their currency, and it becomes practically worthless. Imagine going to the store to buy a loaf of bread and needing a wheelbarrow full of cash. That's hyperinflation. History is littered with examples of hyperinflation, from Weimar Germany in the 1920s to Venezuela in recent years. These events are stark reminders of the dangers of unchecked money printing. Section 6. The Zimbabwean dollar. A cautionary tale. One of the most striking examples of hyperinflation occurred in Zimbabwe in the late 2000s. The government, grappling with economic turmoil, resorted to printing vast sums of money. The result was catastrophic. Inflation spiraled out of control, reaching an estimated 500 billion%. The Zimbabwean dollar became practically worthless. People needed to carry around bags of cash just to buy basic necessities. The economy collapsed, and the country plunged into chaos. It's a stark reminder of the devastating consequences of unchecked money printing. Section 7. Hungary's hyperinflation, a lesson from history. Hungary experienced a similar fate after World War II. The country's currency, the pengő, became worthless due to excessive money printing. Prices doubled every 15 hours. People resorted to bartering and using foreign currencies. The Hungarian hyperinflation had a devastating impact on the economy and society. It eroded savings, destroyed businesses, and led to widespread poverty. It took years for the country to recover from this economic disaster. Section 8. The delicate balance, money supply, and economic stability. Maintaining a stable economy requires a delicate balance between money supply and economic output. When the money supply grows faster than the economy can produce goods and services, inflation rears its ugly head. Think of it like a game of musical chairs. If you have too many players, money, and not enough chairs, goods and services, someone is bound to be left standing. Inflation. Section 9. Why can't we just print our way out of debt? So, why can't governments just print money to pay off their debts? Because it's like trying to put out a fire with gasoline. It might seem like a quick fix, but it will only make the problem worse in the long run. Printing excessive amounts of money leads to inflation, erodes purchasing power, and undermines economic stability. It's a recipe for disaster. Section 10. The bottom line: money doesn't grow on trees. Money might seem like a magical thing, but it doesn't grow on trees. Printing more of it won't solve our problems. In fact, it will likely make them worse. Governments need to find sustainable ways to manage their finances, such as responsible spending and economic growth. Printing money is not the answer. Remember, there's no such thing as a free lunch, especially when it comes to economics.